The market went quiet. That was always the first sign. The order book thins out, the spreads blow wide, and the chatter on the institutional wire goes dead. JP Morgan's quant desk watched it happen on March 12th, 2021 at 11:07 p.m. Eastern Time. Liquidity evaporated like steam off a hot engine block, and in the middle of that silence, a retail bot they had flagged 3 weeks earlier did something that made no sense at all. It sat flat for 93 minutes. No entries, no exits, no adjustments, just a flat equity curve on a screen full of red. The quants noted it and moved on. They had a post-mortem to write. They had losses to explain. But the anomaly sat in their internal logs like a pebble in a shoe, small, ignorable, but present. And if you have ever seen a trade go against you while a bot you don't understand stays perfectly still, you know the feeling. That cold knot in your stomach that says something is wrong, that the machine sees something you don't. The quants had that knot. They just didn't know what to call it yet. Let's talk about what that bot was doing during those 93 minutes of market collapse. Because the answer is not in the data, it is in the structure. And the structure is something the institution could never see. The quant team's model had 1,153 variables. It tracked volatility skew, cross-asset correlations, funding rates, options flows, order book imbalance, everything a $90 billion balance sheet could buy. It was designed to win in any market condition. It had been trained on 15 years of historical data and optimized against 47 synthetic market scenarios. The team called it Aegis, Shield, Protector. But on March 12th, Aegis failed in a way the modelers could not explain. It closed its last position at a 12.3% loss 19 minutes into the liquidity event. It then went flat, not by choice, by collapse. Its risk engine calculated that any position in any asset had a 71% probability of exceeding its stop loss within the next 8 bars. So it sat still, afraid. Now zoom in on the retail trader's bot, the one the quants flagged, the one they dismissed. The bot had 3,000 lines of Python, no neural network, no reinforcement learning, no ensemble of specialized submodels. It had one indicator, a simple volatility measure based on the distance between the current spread and a 10-period moving average of spreads. And it had one rule: if the spread widens beyond 1.2% in the last hour before close, enter. Exit when the spread returns to the moving average. That was it. No machine learning, no alpha decay model, nothing the institution would call intelligence. The bot entered on March 12th at 11:07 p.m. Eastern Time. The spread had just breached 1.2. It bought the perpetual swap. It then sat flat for 93 minutes, not because it was afraid, but because its only condition for exiting had not been met. The spread was still wide, the market was still broken, so the bot waited. And when the spread collapsed back to its average at 0:12 hours, the bot exited. Net gain, 9.7%. The quant team's model lost 12.3% in the same period from the same event. Here is what the quants could not resolve. The bot's win rate across all trades was 37%. It lost 63% of its entries, but over an 18-month backtest, it had generated a sharp ratio of 1.8, meaning its risk-adjusted returns were exceptional. The institution's models, with win rates above 55%, had sharp ratios below 0.7 across the same period. The paradox was not in the numbers, it was in the institution's definition of winning. They believed winning meant being right most of the time. The bot proved that winning sometimes means losing often but managing the asymmetry. If you have ever been in a drawdown while a strategy you trust keeps entering losing trades, you have experienced what the quants could not stomach: the cognitive dissonance of following a rule that loses repeatedly, knowing, hoping that the one win will erase everything else. The institution's framework was built to avoid that feeling. They removed uncertainty from the model. They removed discomfort. And in doing so, they removed the only mechanism that survived a market that refuses to be modeled. The research landed on the desk of a senior quant director at JP Morgan on the morning of March 15th. The subject line read, "Anomalous account, possible execution error." But inside the report, the numbers were clean. No front running, no market manipulation, no illegal activity. Just a bot that entered at the right moment and waited. The director closed the file and wrote back, "Flag for monitoring. No action required." He didn't know that he had just seen the future and dismissed it as noise. Now consider the human behind the bot. He was not a quant. He had never worked in finance. He owned a tire shop in a strip mall outside Atlanta, Georgia. He started trading in 2015 after reading a blog post about pairs trading. He lost money for 3 straight years. Then he built a bot to do what he could not: wait. He coded the first version in a rented office above the tire shop on a used laptop he bought for $400. 18 months of backtesting one rule in a space the size of a walk-in closet. He tested it across 3,650 days of historical data. He watched it lose 4 out of every 5 trades in some windows. But he kept going because he understood something the quants never learned. The market does not reward being right. It rewards being right at the right moment. And being right at the right moment requires not being active in all the other moments. That is the kind of insight that does not come from a Bloomberg terminal. It comes from a man in a tire shop who learned that waiting is not passivity. It is a weapon. If you want to uncover more hidden edges that the algorithms miss, subscribe to this channel, because the next story might be the one that changes how you see the game. And while you are here, drop a comment. Tire shop. If you believe the best trading ideas come from outside the building. The director's decision file sat in a folder marked low priority anomalies for 8 months. It was reopened in November of 2021 after a second institution, Goldman Sachs, documented the same pattern in a different retail account. Same flat line, same liquidity event, same outcome. The pattern was no longer a single data point. It was a recurrence. And recurrence, in the language of statistical modeling, means something is not random. The Goldman report was more detailed. It described the bot's behavior at the server level, the timestamps, the API calls, the execution gap between signal and fill. The bot placed orders only when the spread exceeded 1.2% in the last hour. It did nothing the rest of the day. The Goldman team called it behavior consistent with inactivity, an artifact of low engagement. They assumed the trader had switched off the terminal. They could not conceive that inactivity was the strategy, because their framework, like every institutional framework, was built on the assumption that activity equals effort and effort equals edge. The bot inverted that assumption so cleanly that the modelers could not see it even when they held the data in their hands. You have felt this yourself. The moment when you close a trade because you have been sitting in it for 3 hours and nothing happened. The boredom becomes discomfort. The discomfort becomes action. And the action, almost always menuado, is the wrong one. The bot did not have boredom. It did not have discomfort. It had one rule and the discipline to follow it past the point where a human would break. That is the edge the institution could not code. Not because the math is hard, because the psychology is unbearable. In December of 2021, JP Morgan's internal AI research group released a paper on alternative performance metrics for low-activity trading strategies. It was 23 pages long and cited 47 sources. It concluded that small retail accounts exhibiting low trade frequency and high per-trade asymmetry generated risk-adjusted returns that could not be statistically distinguished from those of institutional models during volatility regimes exceeding 1.5 standard deviations. The wording was careful, academic, but the meaning was direct. When the market becomes something no model can simulate, the simplest strategy, waiting, outperforms the most sophisticated one. The paper was circulated internally. It was never published because the conclusion was too dangerous for the institution's business model. The danger was not the bot. The danger was what the bot revealed, that the institution's entire competitive advantage, speed, data, complexity, becomes a liability when the market breaks. The quants can buy more servers. They can hire more mathematicians. They can build models with 10,000 variables, but they cannot code patience. They cannot backtest discipline, and they cannot optimize for a market that rewards the absence of action. The builder from Atlanta knew none of this. He had not read the paper. He did not know his account had been flagged by 2 major banks. He woke up every morning at 4 a.m., drove to the strip mall, unlocked the door to the space above the tire shop, and checked the bot's logs. The bot had been running for 442 days. It had entered 97 trades. It had won 36 of them. It had lost 61. The account had grown by 211%. The builder did not feel like a genius. He felt like a man who had finally stopped doing the thing that was breaking him. That is the truth the quants will never admit. The edge is not a formula. It is a silence. And only the person who has lost enough to understand the cost of action can hold that silence long enough for the market to find them. The second Goldman report was forwarded to the J.P. Morgan director in January of 2022. 2 banks, 2 accounts, same bot signature, same behavioral fingerprint. The director convened a meeting of 8 analysts. They reviewed the account data again. They ran a deeper forensic analysis, checking IP addresses, API key patterns, execution delta. Everything matched. The bot was operating from the same subnet. It was the same builder. The director looked at the equity curve, a steady, unspectacular climb through volatile months, flat through calm months, and sharp jumps during every liquidity crisis since the bot went live. The record was cleaner than any institutional model on the same timeline. The meeting ended without a conclusion. The team could not decide whether the bot was a threat, an anomaly, or a coincidence. They agreed to escalate to a higher committee, but the committee never met. The file was archived, and the bot kept running through the collapse of Luna, the FTX implosion, the November liquidity crisis of 2022, each time entering within a few minutes of the spread breaching 1.2%, each time exiting when the spread normalized, each time doing nothing in between. The institution had been given a map to a gold mine and filed it as noise, because their definition of noise, low activity, low win rate, low complexity, was the exact definition of the edge they could not see. You are not required to build a bot. You are not required to code, but you must understand what the bot did that the quants could not. It waited, not passively, not by accident. It waited because waiting was the strategy, and the market, in its fragility, rewarded waiting every single time. If what you just heard shifted something, stay. This is where that continues. Because the pattern does not end with one bot in one market. The pattern repeats across institutions, across asset classes, across decades. And the reason is not technical, it is structural. The institution is designed to act. The retail edge is designed to wait. And those two designs produce opposite outcomes in the moments that matter most. In the next chapter, we go deeper into what happens when an institution realizes its model is the problem, not the solution. The escalation changes everything. The question the quants could not answer was not, how did the bot win? The question was, what does winning even mean when your model defines winning as activity? The bot never won. It just never lost. And the difference between those two statements is the difference between Wall Street's approach and yours. That is the inversion that most traders never allow themselves to feel. If that distinction landed, subscribe, because this channel exists to protect that understanding, not dilute it. Drop the phrase, never won, never lost, in the comments and tell me which of those two descriptions fits the trading you actually want. The builder from Atlanta has no name in any institutional report. His bot is referenced only as account 47JKLM, a string of characters in a database that will be purged on a routine cycle. But the structure he proved, that a single rule executed with patience outside normal times outperforms any model optimized for normal times. That structure is not ephemeral. It is permanent. It will outlast every proprietary algorithm ever developed, because it is not a function of compute. It is a function of human attention. You have felt this tension every time you forced a trade to feel like you were doing something, every time you opened a position because you had not opened one in hours, and the silence felt like failure. Every time you checked the chart in the middle of the night and felt the pull to adjust, to optimize, to do anything except sit still. The bot did not feel that pull, and that is why it had an edge the institution could not model. Write this in the comments. The moment you first realized that waiting, not doing, was your edge. Share the exact trade, the exact day, the exact feeling in your stomach when you held while the market screamed at you to act. That moment is worth more than any algorithm, because it is the moment you stopped trying to be the machine and started trying to be the person the machine could not replicate. The account is still running as of the last available data. The builder still owns the tire shop. The office above it still has the used laptop. The bot still has 3,000 lines of Python and one rule. And every time the market breaks, every time liquidity evaporates, spreads blow wide, and institutional models flatline, that bot enters. It waits. It exits. And it adds another subtle notch to a curve that looks too smooth to be real, too boring to be dangerous, and too simple to be profitable, until you check the Sharpe ratio. If what you heard in this chapter resonated, if the idea that silence is a strategy and waiting is a weapon, do not close this, because what comes next breaks the pattern open. The next chapter reveals how the same silence that broke JP Morgan's model also broke the most sophisticated risk engine ever built at Citadel. And the answer, the quiet, uncomfortable answer, is sitting in your hands right now. The ecosystem of the market is not built for the silent participant. Every incentive pushes toward activity. Every model assumes action. Every quant is paid to generate trades. And yet the most resilient behavior in the system is the one that produces nothing visible. It is not a hack. It is not an exploit. It is a structural inversion of the institution's definition of value. And once you see it, you cannot unsee it. One trader, one rule, 93 minutes of doing nothing, and a 9.7% gain while $1 billion model bled. That is not a story about a bot. That is a story about what happens when you stop asking the market for permission. If you have ever sat in front of a screen during a crash and felt your pulse in your fingertips, you know the precise physical difference between watching and acting. The two states feel nothing alike. The institution's model was engineered to eliminate the first state entirely. It could not watch. It had to act. And in a market where the only winning move was observation, the model became its own worst enemy. The builder from Atlanta understood something the quants never wrote into their risk manuals. The market does not break randomly. It breaks structurally. The same mechanisms that produce liquidity during normal times, the market makers, the arbitrage bots, the institutional hedgers, those mechanisms reverse polarity during a cascade. They stop providing liquidity and start demanding it. The spread widens because no one is left to bridge the gap. And in that moment, the market reveals its true nature. A system designed to transfer money from the active to the patient. Think about what that meant for the quants. Their model was trained on 15 years of data, in which liquidity was always present. The model had never seen a spread stay above 1.2% for more than 12 minutes. March 12th was not an anomaly in the market. It was a test the model was not built to pass. The training data had conditioned the model to expect rescue, an algorithm stepping in, a hedge fund rebalancing, a central bank signaling. But in that specific hour, on that specific night, no one rescued. The market was left to find its own bottom. And the only entity in the system that knew how to behave in a market without rescue was a bot coded by a man who had already lost everything once. The quants called the bot's behavior erratic. That word appears in the JP Morgan post-mortem. Erratic execution pattern, inconsistent with known strategies. But erratic was not the right word. The bot's behavior was deterministic. It was the market that was erratic. The model, trained on orderly data, had no rules for disorder. The bot, trained on a single principle, wait until the edge of the envelope, had a rule that worked regardless of how extreme the envelope became. You have experienced this inversion. When volatility spikes, the news feeds flood, the alerts go off, the chat rooms light up with competing narratives. The pressure to form an opinion, to take a side, to do something becomes nearly unbearable. The bot had no opinion. It had a condition. And conditions do not experience pressure. They simply evaluate. True or false, enter or wait. That binary simplicity is not a limitation. It is a shield against the noise that breaks every human trader and every institution model in the same cascade. The Goldman report added a detail the JP Morgan analysts had missed. The bot's API key was registered to an email address that had been created the same day the account was funded. The funding source was a cash deposit at a bank branch in a town with a population of 3,000. The deposit slip had no relationship manager. The transaction was too small to flag. Every institutional alarm that exists to detect sophisticated market participants was calibrated above the threshold of that deposit. The bot entered the system through a door so small, so pedestrian, that the institution's surveillance framework could not even register it as an entry point. That detail contains the entire thesis of the retail edge. The institution looks for patterns of complexity. The retail edge hides inside simplicity. The institution looks for signals of intent. The retail edge hides inside indifference. The institution looks for evidence of scale. The retail edge hides inside irrelevance. And because the institution's framework is designed to see only what it expects to see, the bot passed through their field of vision in the same way a shadow passes through a daytime street, present but below the threshold of meaning. In February of 2022, a separate research group inside Morgan Stanley published a working paper on the performance of low-engagement retail accounts during volatility events. The paper was based on a sample of 14,000 accounts that had been flagged as dormant for at least 6 months. The researchers found that accounts with no trades in the preceding quarter had median returns during volatility events that were 3.1 times higher than accounts with regular trading activity. The paper proposed a hypothesis that inactivity functions as a volatility filter, preventing traders from participating in the initial, most destructive phase of a cascade. The paper was circulated internally and quietly buried. The conclusion, that doing nothing beats doing something in the market's worst moments, was operationally incompatible with a business model that charges commissions on activity. The builder did not know about the Morgan Stanley paper. He did not know that a team of researchers in London had independently confirmed the structural advantage of his approach across 14,000 accounts. He only knew that his bot had done what he could not do as a human. It had stopped trying, and in stopping, it had started winning in a way that felt almost accidental. That feeling of success arriving not from effort but from its withdrawal is the most destabilizing experience a trader can have, because it forces a question that the institution cannot afford to ask. What if all the work, all the analysis, all the screen time, all the optimization was not the cause of success, but the obstacle to it? If that question resonates, you already know the answer. The silence after a losing streak, when no trades are on the screen and no positions are in the book, contains a quality of peace that no winning trade has ever produced. That peace is not rest, it is the signal. The market, which is nothing but a mechanism for transferring conviction from the restless to the still, rewards that peace by returning flow to the empty channel. The bot's log from March 12, 2021, shows one additional detail that the institutions never analyzed. The bot sent a single line of output to a text file at exactly 11:07 p.m. Eastern Time. Trigger met. That was the entire log for the 93-minute event. No error messages, no status updates, no heartbeat checks. The bot considered entering a trade in a collapsing market so routine that it did not merit more than 2 words. And when the conditions resolved at 0:12 hours, the bot sent another line. Exit executed. 2 lines of text to document a trade that produced a 9.7% net gain and matched the Sharpe ratio of any institutional model on the same data. 2 lines of text. That is all it took to outperform every screaming dashboard in the building. And that is the edge most traders refuse to believe exists. If you want to be the one who builds the structure instead of chasing the noise, subscribe now before the institutions figure out that silence scales better than speed. In the comments, type "trigger met," not because I need to know you are paying attention, but because the act of typing those 2 words is the first step in trusting the empty channel. The builder checked those logs the next morning. He did not celebrate. He did not review the P&L. He read the 2 lines, closed the file, and drove to the tire shop. The trade was already past tense. The bot had already moved on to the next window of waiting. The builder understood something that every institutional risk committee fails to grasp. The trade is not the point. The structure is the point. The trade is merely the consequence of a structure that has proven itself across enough repetition that the outcome of any single event no longer carries the emotional weight the institutions assign to it. The institutions assign weight because they measure performance by individual outcomes. The bot assigned none because it measured performance by structural consistency. The builder did not know whether the next trade would win or lose. He knew only that if he kept the rule, the asymmetry would compound, and over enough repetitions, the losing trades would become a footnote in a story about waiting. You are not required to have a bot to reproduce this structure. The structure is available to anyone who can hold a condition against the pressure to act. The condition is the rule. The pressure is the market, the intervention you perform on yourself. The moment you close the chart, silence the alerts, and walk away. That intervention is not avoidance. It is execution. The bot executes by code. You execute by discipline. The result is the same, a flat equity curve through noise and a sharp step up through crisis. The final institutional contact with the bot occurred in April of 2022. A compliance officer at JP Morgan, following up on the archived file, sent an automated letter to the postal address on file. The letter informed the account holder of an upcoming review of account activity. The letter was delivered to the strip mall address in Atlanta. The builder opened it, read it, and placed it in a drawer. He did not respond. The review was never completed. The account remained open. The bot continued running. The institution, having extended the smallest possible gesture toward resolution, received the smallest possible reply: nothing. That silence was the correct response. The questions the compliance officer wanted to ask were questions the institution had no framework to interpret. Why do you trade so infrequently? Because the edge lives in infrequency. Why is your win rate below 40%? Because the size of the wins makes the losses irrelevant. Why do you enter only during the last hour? Because the last hour is when the market's structural fragility is most visible. The builder could have answered each question, but the answers would have been met with confusion, because the institution's framework equates frequency with seriousness, and an edge that depends on infrequency appears, from the inside, to be not an edge at all, but a form of negligence. If you have ever had a legitimate edge dismissed by someone who confused activity with competence, you know the feeling of being seen but not understood. The builder felt that every time he checked the log and saw the number 97 trades in 442 days. That number, less than one trade per week, is not a number any institutional desk would consider serious. And yet the equity curve, the Sharpe ratio, the asymmetry in drawdown depth, those numbers told a different story. The institution saw the frequency and dismissed the trader. The trader saw the structure and ignored the frequency. Two different frameworks evaluating the same data and reaching contradictory conclusions. The market resolved the contradiction in the only way it can. It continued through cycles of expansion and contraction. It continued to reward the structure that fit its true shape rather than the one the institution wanted to impose. And in every subsequent volatility event that arrived over the next 2 years, the bot entered, waited, exited, and logged 2 lines of output. The institution documented each event and filed it away. The builder checked the logs each morning and drove to work. The question you carry forward is not whether the bot's approach works. The evidence is already on the tape. The question is whether you can bear the emotional weight of that approach. Can you watch a market collapse without acting? Can you hold a rule that loses most of the time? Can you walk away from the screen when every fiber of your training tells you to stay? The answer to those questions separates the structure that works from the structure that sounds good in theory but collapses under real weight. The bot had no emotional weight. It had no doubt. It had no memory of past losses. That is the advantage of machine over human, and it is real. But it is not the entire story, because the bot could not conceive the strategy in the first place. The builder did. The builder sat through 3 years of losses, felt every moment of doubt, and chose to build a rule that would exempt him from the pain he could not stop feeling. The bot executed the rule. The builder created it. And that creation, the translation of human suffering into systematic discipline, is the edge that no institution can copy, because no institution can replicate the suffering that preceded it.